Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 21st, 2026. How you doing? I hope you're doing okay. It was a rough week in the market, so I hope you're hanging in there, staying safe, keeping your chin up. Not a great week for me either, I must admit, but sometimes in trading we don't always have positive weeks. Most of the time, I do, to be honest with you. But this week was a different story, of course, what's going on in the Middle East and the oil prices and so forth. The market certainly does not like the uncertainty and the danger of this all. And so, yep, we were down for sure. So I hope you're hanging in there. And like I said, I hope you keep your chin up. What goes up comes down. What goes down goes back up. The important thing is you're just patient and wait for a legitimate entry signal. So appreciate you being here. I hope you're going to have a nice weekend, have a little relaxing weekend, do some fun stuff, and get away from the market for a little bit. So the format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades, all the positions that I had from last week. We're going to talk about when I entered the trade, why I entered the trade, what the signal was, or what the signals were, ideally, how I position size based upon the volatility, how I place my emergency stop, how I place my end of bar stop, how I place my trailing stop level, how I take partial profits if the market moves a certain amount each day from the previous day's close, and then ultimately how I exit the trade to the upside. So I hope you're going to find this helpful. I got stopped out of a lot of stuff, gave out some profits this week. But there's always next week, right? And as long as you follow the rules in the long run, I think you're going to do just fine. After we take a look at my trades, we're going to talk a little bit about trader psychology. Always the most important skill is the ability to create a plan, and then more importantly, to follow the plan. Creating the plan is not hard. Following the plan is hard. But, I'll give you a couple examples today or this week of some trades I took. I got out. I didn't want to get out, but I'm sure glad I did, right? I had the plan and I followed it. It's the most important thing. So I always like to teach trading psychology. It's such an important part of trading, and I hope that will be helpful for you as well. Just last night, I went through all of my master watch list. I went through all the symbols of my master watch list, and I have identified some potential trades for next week. Now, these are not where they need to be yet, but actually a lot of them are very, very close. These are important confluences of levels that they didn't quite reject. But if it goes down, if next week we're down a little bit more and then a bounce, or if we head up, there'll be some potential legitimate signals. So I think I have some really good ones, all names that I'm sure that you'll know, that are very close to some really important levels. Doesn't mean the trade's going to work, but it means that you are at a confluence of signals and a good risk to reward ratio. And really that's all we can ask in trading. After that, the market's going to do what it's going to do. But we have to put ourselves into the position to have a good risk to reward ratio. So that if we're wrong, we have more likely be wrong small, but if we're right, we have the ability to have an outside gain. So I hope this is going to be helpful for you to go through and take a look at what I'm looking at next week. And if there's anything in this podcast that you find helpful or valuable today, I really would appreciate it if you could hit the thumbs up button. It really helps to build the channel, keep the channel around, and let YouTube know that there's some valuable content here. All right. Well, let's get the U.S. legal disclaimer out of the way, and we'll come back and we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, everybody, and let's get started on the current open daily positions that I have. I entered Palantir, PLTR, all the way back here on the 5th of February at 129.62. Now, I trade multiple different trading strategies, but whenever you see a green box like you see here, it will involve an order block. Now, this order block was formed in the past, and I'll show you that in a minute. But the reason I took the trade was you can see during the day we went below the order block, but then we closed back up in it. That was my signal. But before we get into the whole trade, let's go back and find out what this order block stuff is about. And this order block happened all the way back here on the 1st of July. Now, an order block, in order to have an order block, you need some criteria. The first criteria is that you need a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. So here we have a swing low. After that swing low, we need to find a swing high. The swing high is the opposite. A swing high has a lower high to the left and a lower high to the right. So, with me so far, swing low, swing high. Check, check. After we have found the swing high, we need to find another swing low that is lower than the first swing low. Remember, here's the first swing low, here's the swing high. These three bars make another swing low that's lower than the first swing low. Here's the low, higher low to the left, higher low to the right. Okay, we have a swing low, we have a swing high, and we have a lower swing low. Once that lower swing low happens, we need to refer back to that first swing high, and I've drawn a green line there. Now, after you have a swing low and a swing high and a lower swing low, if in the future the price moves up above that first swing high like it did here, now we can identify the order block. The order block is the lowest closing bar prior to the market structure change. And so that's why I've highlighted the green box comprises the high of this bar and the low of this bar, and I'm bringing this order block into the future. Now, once we broke market structure and we changed market structure to the upside, and then Palantir just went on a tear, is it fair to say when the price is all the way up here at like 188 that smart money was buying back here at 131? Of course, in hindsight, it's obvious, right? So this order block, I consider this smart money because we ran up, the smart money was buying here near the low. So I want to bring this smart money area into the future. And if the price ever gets back to that smart money area, that's where I want to be looking for the trade. All right. So this started here on January 1st. So look, we'll go way, way, way into the future. And we eventually got back down to that area that was smart money before, like I just showed you. So this is where I entered the trade. Now, there's different ways you can enter a trade in an order block. You can take the rejection of the high of the order block. You can take a rejection of the low of the order block, like I did here. Or you can have some kind of moving average or other level inside the order block where you could take the trade as well. But I always make my buying and selling decisions based upon the closing price. So this is why I bought on this day. During the day, we went under the order block and then we closed back in it. So that is a rejection of the bottom of the order block. So I entered here at 129.62. Now, after I entered, I have to decide, well, how many shares am I going to buy? And this is your most important decision when you get into a trade, in my opinion. Some people just buy a flat 100 shares, flat 200 shares, flat 300 shares. But in my opinion, it's important to position size based upon the volatility of the market. And the value of the 2 ATR up here, right this moment here is 1244. This will do everything for you. An ATR is an average true range, times 2 gives me the 2 ATR value. So the way I figure out how many shares I'm going to buy is, first of all, I have to know how much money I have in my trading account. Let's just say it's $100,000. I simply take 1% of that. 1% of $100,000 is $1,000. And I divide that by the value of the 2 ATR. Right now it's 1244 divided by 12.44. Presto magic, I know exactly how many shares to buy based upon my account size and what the current market volatility is. When market volatility is higher, this number is going to be much higher. And if I divide a higher number into my $1,000, it's going to give me a lower amount of shares to buy. If volatility is low and I divide that into my maximum allowed loss of $1,000, it's going to have me buy more shares. So this is an invaluable tool to be able to position size based upon volatility, and that's how I do it. So, okay, so I bought here with the rejection of the bottom of the order block from that order block in the past at 122, 129.62. Now, the first thing I do is I take my entry price and I minus the value of whatever that 2 ATR was that I used in the equation. And I draw a red line with 2 ATRs below my entry. This is my emergency stop. So if I have 80 shares and it moves $12.44, because we just did the math, how much am I going to lose if I get to my emergency stop? I'm going to lose 1% of my account. Not fun, right? But you can recover from a 1% loss in your account. There's no doubt. Now, I just said that I make all my buying and selling decisions based upon the closing price, and that's true except for one exception, and that is if I hit my emergency stop. If I hit my emergency stop anytime in the day, whether it's right when the market opens or right before the market closes or anywhere in between, I get out because that is my maximum allowed loss on this trade. Now, the good news is that the emergency stop only gets hit about 5% of the time. The other 95% of the time, if I have a loss on the trade, it is not going to be because of my emergency stop. It's going to be because of my end of bar stop. And depending on what strategy I'm using, I have different end of bar stops. But on this particular trade, I got in because it rejected the bottom of the order block. Therefore, in the future, if it closes below my order block, below the bottom of the green box, I'm simply going to get out, even if it's 1 penny. The loss is going to be very, very small, but it lost the key area. All right. So on this particular trade, I took the trade because it rejected the bottom of the order block. In the future, my end of bar stop will be if it closes below the low of the order block. Okay. Now, after I've made the trade, I've entered the trade, I've placed my emergency stop, I've placed my end of bar stop. The next thing I want to do is I want to identify where my trailing stop level is. And for that, I need the value of the 1.5 ATR. Right here, right this moment, the value is 9.33. What I do is I take my entry price wherever I entered, then I go up whatever the value is of the 1.5 ATR above my entry price, and there's my orange line. This is my trailing stop level. And the way that I use this is that when I enter, if the trade starts going my way and it actually gets to my trailing stop level, it actually moves 1.5 ATRs, I don't do anything. It just means that now I'm in trailing stop mode, which means that in the future, after I reach trailing stop mode, if I have a close below a previous bar's low, I'm going to exit half the position. And it's just good trading when you enter a trade and it starts moving your way to start tightening up your stops. Well, if it moves 1.5 ATRs, I'm off to a pretty good start. And so then if I have a close below previous bar's low, I'm going to exit half. And by exiting half, just by default, I'm moving all my stops up like 50% because I've gotten rid of half of the trade. Now, I keep the other half because if it goes up, I'm going to be glad that I still have 50% left. If it goes down, I'm going to be glad that I sold half, right? So it's one of the only win-wins in trading. So, all right. Now, everything I've talked about so far, the emergency stop, the end of bar stop, going into trailing stop mode, and then selling half if you have a close below previous bar's low after reaching trailing stop mode. These are all defensive moves. So in other words, if the stock moves against me in the direction that I don't want it to go, I have to take action. but I also like to play offense in my trading. And I play offense in my trading by taking partial profits each day if it moves a certain amount from the closing price. And so I'm still in this trade. Let me show you how I'm going to set this up for Monday. Okay. I take the closing price of the day, which is $150.68. And now I look to the value of the 0.45 ATR. The 0.45 ATR today is $2.80. Now it's going to move every day, but right now it's 280. So if I take the closing price, 150.68 plus 280, my first profit target for Monday is 153.48. 153.48. Okay. Now, if we reach there on Monday, how much do I sell? It's a good question. 10% of however many shares I go into the day with. If I go into the day with 50 shares and I hit the first profit target, I simply take 5. But I'm going to place 2 more profit targets, and I would also take 5 at each one of those if it gets there. So the first profit target is the closing price plus the value of the 0.45 ATRs. Add that together, you get 153.48. Now you take the first profit target, 153.48, and you just add the 0.45 to it again, which is 2.8. My second profit target for Monday, 156.28. So we'll mark that one up there. And again, what would I take off at the second profit target? Simple, just 10% of however many shares I came into the day with. And I do it one more time. I just created the second profit target, 156.28. I just take that value, add it again, the 2.8 to it. My third profit target for Monday is 159.08. There you go. Those are my 3 profit targets. Now, if it goes up nicely on Monday and I hit 3, perfect. Great. I sold into the strength, right? I'm selling a little bit when the market's offering me a little something. If it goes down, well, I won't hit any, and I'll just have to recalibrate and redo to the numbers the very next day. But this week especially, and you'll see not so much in this trade, but you'll see in other trades, how important it was for me to take partial profits when the market offered them to me. Okay, so we've kind of done the basics of each little component, but now let's start all over and we'll run through the trade and we'll see. Okay, so I entered here on the 5th of February at 129.62. Why? Rejection of the bottom of the order block. I position size. I place my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I place my 1.5 ATR trailing stop level above. And here we go. Next day, move my direction. Great. Hit a profit target, reduce my position size a little bit. The next day, big day up, I hit 2 profit targets on this day up. In addition to that, I got to trailing stop mode. I don't do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Next day was down, but I take no action because it didn't close below the previous bar's low. The next day did close below the previous bar's low, so I took off half of the remaining shares that I had for a gain of 4.61%. Next day, down again. I thought I was going to get stopped out of this, but do you see how during the day we were under the order block, but we closed back in the order block? That kept me in the trade. Same thing the next day. We opened under, closed back in, kept me in the trade. Next day again, tested below the order block, closed back in the trade. So you can see there were no sellers during the day. There were no net sellers that caused the stock to close under the order block, and that's why it reversed back up. The next day was up. At the beginning of the day, during the day, it was up nicely where I hit another profit target into that strength. And we moved down, sideways. Again, we tested the area below the order block, but closed back in it, kept me in the trade. The next day, again, fooling around with the bottom of this order block, and it barely kept me in the trade. See how that just barely closed in the green, kept me in the trade. Next day was up, great, took some profits. Next day up a little bit, not for a profit target. Next day up a little bit, not for a profit target. Next day up big, where I hit multiple profit targets. Next day up a little. Next day up again, profit targets. Here on the 6th, had a big move up, profit targets. And over the last 2 weeks, basically it has just gone sideways and really done nothing. So remember now, my end of bar stop is a close below the low of this order block. We haven't got there yet. Really nothing I have to do. If it continues up, I'll continue to take profit targets. If it goes down, closes below the order block, I'll get out. Right now we're at a 51.05 RSI. If it does take off for some reason and get to at least the 65 RSI level, now we'll close below the 5 EMA will be my stop. Another option is if it continues higher and rejects the 70 RSI, I will exit half the remaining shares there. And then after the rejection of the 70 RSI, if I have a close below a previous bar's low, I will completely exit the trade. So I know exactly what I'm going to do this trade, regardless whether it goes up, down, sideways. It's good to have a plan, and it's good to follow your plan. So this particular trade, the remaining shares I have on this are up 13.98%. ARK. All right. I took ARK here on the 12th of February at 68.41. Why? 2 reasons this time. Just like Palantir, I entered because it rejected the bottom of the order block. During the day, it was below the order block, closed back in the order block. But in addition to that, also incorporated a deep dip buy signal, which is an under 30, over 30 on the RSI. On this particular day, we did go under 30 during the day and then close back above 30 at the end of the day. So those are the 2 confluences: intraday rejection of the 30 RSI, intraday rejection of the bottom of the order block. So I entered here 68.41. I position size for volatility and my account size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the bottom of the order block or the 30 RSI. If one happens, the other is going to happen. I place my trailing stop level 1.5 ATRs above. Next day went up. Great. Good start to the trade. Hit a profit target. Next day, nothing. Next day, hit another profit target into the strength. Got to trailing stop mode. Couple days sideways. And then here is our first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the shares that I had remaining for a gain of 2.29%. Next day, up like a rocket ship. Sold partial profits into that strength. Next day, up again. Took some more profits into that strength. Next day, up again. Can't remember about that one. Next day, down. Next day, up. Next day, down. Next day, up. Profit target. Then a couple days down. And then a nice move up where I am selling into the strength while I have the strength. And then we move back down. On this day here, took a profit target. Can't remember about this day. And now look at this. Now we've come all the way back. My end of bar stop is a close below the low of the order block. We got right basically to my entry today, and that's where we bounced. But just to put in a plug, right, for taking partial profits, am I glad I took partial profits here and here and here and here? 100%. Because now we're much lower. Even on some of these days where we had these little counter rallies, I took off some of the position into that strength. And that just has the effect of tightening and tightening and tightening your stop because you have fewer and fewer and fewer shares. All right. So this particular trade at one point was up pretty good. It's still up 1.07%. And going forward, again, if I have a close below, excuse me, if I have a close below the low of the order block, I will exit the trade. Okay, so that's ARKK. Now let's go to silver. Okay, silver. All right, silver is a different type of position, a different type of strategy that I took. I got long on silver here on February 18th at $69.80. You can see the day before my entry, there was a bar here that I highlighted in blue. The reason I highlighted that in blue is that is what's called an abandoned baby. An abandoned baby is 3 bars. Bar 1 gaps down to bar 2. Do you see how from the close to the open we gap down? Okay, that's bearish sentiment. For whatever reason, everybody was bearish on silver. However, the very next day we gapped up. So we went from a gap down immediately to a gap up. When that happens, usually there's a lot going under the hood there fundamentally. And in my experience, when you have an abandoned baby, about 70% of the time in the future, you're going to see prices higher. About 30% of the time, you're going to see prices lower. So in addition to the abandoned baby, we also rejected the top of the order block, right? The green box. See how the previous day we were in the order block, but then we closed above it. That's rejection of the high of the order block. All right, so those are the two confluences of why I took the trade. Now, on these particular trades with the abandoned babies, I do not go into trailing stop mode. I do not take partial profits. On this particular strategy, I make it very simple. I place a 2 ATR stop below so that if I'm wrong, I lose 1% of my account. I place a 4 ATR profit target above me so that if I'm right, I make 4 ATRs or 2%. So on this particular trade, I'm risking 1% to make 2%. That's an asymmetrical risk, right? I have a higher reward than my risk. And in my experience, when you have these abandoned babies, more times than not, you're going to get the 4 ATR instead of lose the 2 ATR. And you can see initially right out of the gate, that first week and a half really took off great, really was going my way. We moved back down. We went sideways for a while, and then over, of course, the last week, silver and gold have been extremely, extremely weak. I am not to my emergency stop yet, but I am down on the trade, 13.4%. Now, does that mean I'm down 13.4% in my account? No, of course not. Because if I got to my emergency stop, I only lose 1%, right? So it sounds like a big percentage, but I'm down about just a little over 0.5%. But I'll just let this play out. I'm either going to hit the 2 ATR stop or I am going to hit my 4 ATR profit target. One of the two. UNH. All right, UNH. I entered UNH here on the 25th of February at 282.86. This particular strategy is called a higher low V2. Let me bring your attention to these two green lines. This is the 1 ATR, this is the -1 ATR. Anywhere inside this, the two greens, is called the value zone, okay? The requirements for a higher low V2 is first you need to close below the value zone. Well, here's the value, the bottom of the value zone way up here. We clearly closed below it. The second requirement is that you go back up into the value zone, which we did. The third requirement is that you have a pullback and then create a V2, a V1 or a V2. This is a V2, and let me explain why. A V2 consists of 3 bars, bar 1, bar 2, and bar 3. For a V2, bar 2 has to go under bar 1's low, and bar 3 has to close above bar 1's close, and that's what happened. And it's very important that that V1 or V2 closes in the value zone. By the way, if you'd like to learn more about V1s, V2s, you can go to my YouTube channel. I have a video that I made on it that goes into detail about it. So I entered at 282.86. Now, as soon as I enter, I position size like I'm supposed to. I always place my emergency stop 2 ATRs below. My end of bar stop on a higher low V2 is halfway up the second bar. That's why I drew the red line here at 274.70. My stop is in the future. If we close below that line, that's the end of the trade for me. That is my end of bar stop. And the halfway of the number 2 bar, it's called the washout bar. halfway of the V2 bar, there tends to be a lot of support. And you can see, interestingly enough, today at the low, that's almost where we got. So, all right. So I entered the trade. The next day it went up. Great. I sold into some of that strength. The next day went in up again. Sold into that strength. Next day up a little, but not enough for a profit target. Then we kind of meandered our way down here, still staying above our stop. On this day here, the 13th, we had a nice up bar, took a profit target. Then we went up a little bit, but now with the rest of the market, UNH has come back down. I'm still in the trade because it has not closed below halfway my washout bar. That's at 274.70. So Monday, if it closes below here, I'm just out of the trade. If we go up, I'll continue to take profit targets. But at the moment, this particular trade is down 2.59%. Google. All right. Google is a combination of an order block with a key level inside of the order block. Remember, you can take entries with the high of the rejection of the high of the order block or the low of the order block, or if you have a moving average inside the order block, you can use that as your level. But in this particular case, I made my own level, and this is the green bar here at $300.50. So how did I come up with that? Simply this bar here on the 9th. You see the big up bar that we have here? Whenever you have a large up bar, the halfway of that up bar is going to provide some kind of natural support from a Fibonacci standpoint. All right. So um, the reason I took the trade, because we're in the order block, we went up. I didn't buy this here, but I waited for a pullback and rejection of that level. And that's right where it bounced. Interesting. So I took the trade here, $302.20. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the green line, the $300.50 line. Okay, I placed my trailing stop level 1.5 ATRs above. Next day, started off good, hit a profit target. Great. Next day, great. Hit multiple profit targets into this move up. Next day, we attempted to get to the trailing stop level. We did not get there. And then, of course, the last 2 days have been down. I thought for sure during the day that I was going to get stopped out of this with the close below the green line at $300.50. But as you can see, it recovered by the end of the day and it closed above, keeping me in the trade. So that level was a key level. I am currently down on the trade 0.42%, but I'm glad to still be in it with the recovery and the close above the $300.50. So moving forward, Monday, if we close below this green line, I'm simply out of the trade. If we start moving up, I'm going to take profit targets, and I'll continue to do that until we get to a 65 RSI level. If we get to 65, then a close below the 5 EMA will be my exit on the trade. And of course, I told you before about rejecting the 70 RSI and getting out of half, and then getting out of the second half if you have a close below previous bar's low after rejecting the 70. So this trade, now just look at this. Am I glad I took profits here? Am I glad I took some profits here? Yeah, of course. I locked these in at positive levels, profitable levels, and it mitigated my position size. So this move down mitigated the loss, and I would have had more loss had I not taken the partial profits when the market gave them to me. So this trade down 0.42%. Apple, I entered Apple today, right near the close of the market. Probably my favorite trade, one of my favorite trades anyway, is a 200-day moving average inside the order block, okay? The 200-day moving average is a key level, okay? The 200, the 250, the 300, these are all key moving average levels that large financial institutions like to key off of and look for rejections of. But not only is the 200-day moving average a legitimate signal, rejection of the 200-day moving average, the 200-day moving average lives inside the key area of the order block. All right, so it's a key level within a key level. And I was looking, if you've been watching the podcast, I've been talking about getting into Apple way up here. I said, if it gets down to that 200, that's what I'm looking for. Well, look what it did today. It rejected the 200-day moving average. So that's why I entered the trade. I entered at 247.80. I placed my emergency stop 2 ATRs below. My end to bar stop is simply a close below that 200. My entry is very close to that anyway, right? That's a good risk to reward ratio. And then I placed my 1.5 trailing stop level 1.5 ATRs above. So I got in basically exactly where it closed. So this trade is break even at the moment, but going forward, Monday, if we close below the 200, I'm out. If we crash down and get to my 2 ATR stop, I'm out. If we start moving up, I'm going to take partial profits. If we move up enough for me to get to trailing stop mode, then I go into trailing stop mode. All right, so hope that's a good explanation. So there you go, and that's the brand new trade. Now, I did have a couple trades that I got stopped out of this week, and I will share those with you now. I got into Philip Morris back here on the 11th of March at 165.40. Why? Rejection of the 200-day moving average, the black line, inside the order block. Exactly the same trade as Apple. I placed my emergency stop 2 ATRs below. My end of bar stop simply closed below the 200. I placed my 1.5 ATR trailing stop level above, and next day took off like a rocket ship. Really grateful for that. Sold some profit targets into that strength. The next day up again, sold into that strength, which was very important in hindsight. Also got to trailing stop mode. Next day didn't really do much. The next day we had our first close below a previous bar's low. After reaching trailing stop level, what did I do? I took off half of the position for a gain of 3.53%. Next day, got hammered, but it held and closed above the 200-day moving average, so I stayed in the trade. The next day, Thursday, it closed below the 200. I had to get out. The remaining shares there, I took a loss of 1.27%. But looking at this now, am I glad I took profits while I had them? Yes. Am I glad I had a trailing stop rule that told me to get out of half? I took half up here, again, at profitable levels. So the remaining shares that I had show a loss of 1.27%, but because of what I'm showing you and because of the rules, I was still able to make money on this trade. So I got out of half for a gain of 3.53%. And the second half, I got out of a loss at 1.27%. Last one on the dailies is Tesla. I entered Tesla here on the 16th of March at 395.54. Rejection of the 200-day moving average inside the order block. Next day was up. Good start to the trade. Very next day, we closed below the 200, right? That was my end of bar stop. So it was a loss. I got out of the trade, had a loss of, what does that say? Ah, shoot. All right, do this again. See if I can read that a little better. All right. Do it this way then. Yeah, about 0.69%. Okay, so it was a loss. It was a small loss. But look what happened to Tesla after I took my loss. Am I glad I got out of the stock? Yeah, of course. Obviously, right? But this is a good example of waiting for a legitimate signal, rejection of the 200-day moving average inside the order block, and then having a good risk to reward ratio so that if it closes below, even barely, I get out. Yeah, okay, I took a 0.69% loss on the trade, but following my rules, Saved me a lot of money to the downside. All right. So yeah, remaining shares on Tesla, loss of 0.69%. Okay, so those are the daily trades, both the open and the weekly. Let me take you over to the weekly trades. I also like to trade weeklies on the weekly bars. The setups, the patterns are all the same. These are weekly bars, so every bar is a week. I entered the dollar on 7/11/25. I've been in this trade a long time. I entered at $26.31. Why? Two reasons. First reason, the previous week we closed under the 200-day moving average. The week that I took it, we closed over the moving average. That is a deep dip buy signal. Close under, close over. The other signal was that the previous bar's close was in the order block. This week's close was above the order block, right? So there's two primary signals: close under, close over the 200-day moving average, and a rejection of the high of the order block. I entered at 26.31. My end of bar stop would simply be a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level 1.5 ATRs above, and here we go. The next week was up, great, hit a profit target. Next week came down, rejected the 200, closed above it. It kept me in the trade. Next week, up strongly. I hit multiple profit targets into this strength. I also got to my orange line, so I'm in trailing stop mode. Okay, so in the future, if I have a close below previous bar's low, I'm going to get out of half. Next week was down, but it did not close below the previous bar's low. The next week did. This week closed below the previous bar's low, so I got out of half the position with a 0.49% gain. Then for about a month, we just moved sideways and didn't do anything. This week was interesting because during the week we were below the 200. And remember, the close below the 200 is my stop, but it recovered, closed back above, kept me in the trade. Next week was up, hit a profit target. Next week, kind of a nothing burger. Next week, up again, profit target. So I'm selling into that strength. Couple weeks of sideways motion, not another move up, took some profits into that strength. Let's see here. And then we went down for a month, kind of sideways. We had a 2-week rally. This particular week, I took some profits. Then we really came down strong. I thought for sure I was going to be out of trade on this week, but yet it closed above, kept me in the trade. Next week, up, profit target. Next week, we retested the 200, but it closed above, kept me in. Next week, up again, sold into that strength. Next week, nothing. Next week, up strong again, sold into that strength. And the week after that, multiple profit targets into this strength. Now, you heard me talk about being at 65 RSI or higher, and if that happens, getting out with the close below the 5 EMA. Well, here's the 5 EMA, this thin blue line. This week, we actually got to it and touched it, but bounced. So just to make this easy, in the future, if next week, if it closes below the 5 EMA, that will be the end of the trade. Conversely, if it goes up and rejects the 70 RSI, I'll get out of half, and then I'll get out of the second half if I have a close below previous bar's low after that. So the remaining shares that I have on UUP are up 4.95%. All right, the last trade that I have is IBM on the weekly. So I got into IBM here on the 27th of February at 238.91. Great trade, or great setup, I should say. Rejection of the 100-week moving average, that's the red line, inside of the order block. I got long 238.91. I position size correctly. I placed my emergency stop. 2 ATRs below me, that's down here. I placed my 1.5 ATR trailing stop level above the orange. And then the next week started off great. Hit profit targets into that strength, right? Just took it off. When the market gave me something, I took something. Next week down, this week down again as well. My end of bar stop is a close below the 100-week moving average. The 100-week is at 237.26. So giving back most of the gain on this particular trade, but the remaining shares that I have are up 1.22%. But again, this bar here, the blue bar that I took the week after I took the trade, you can see the importance that I sold into that strength. So IBM remaining shares up 1.22%. All right, so those are all the opened and closed trades going into next week. We'll see what next week brings. Before we look at next week's potential trade, let me talk a little bit about trader psychology first. This is from the Divergent Trader. Great guy on Twitter, on X. You can follow him at Trader Divergent. He has some really good posts over the years. I enjoy reading them. And let's see what he has to say. 10% is identifying a trade. 10% of the work involved in trading. 10% is identifying a trade. Identifying a trade is not hard. Did it close above this level? Did it close below that level? That's the easy part. And he's attributing 10% of output to that. I agree. It's very easy to identify the trade. 20%, so double the work, is managing the trade after you enter. That's true, right? Taking profit targets, going into trailing stop mode, and making the moves that you are supposed to trade. 70% is managing yourself and your emotions. And everybody, I deal with a lot of traders. I know a lot of traders. You know, I teach students around the world, and I see this from everybody. It's the managing your emotions and following your plan. It sounds easy, it's not easy to do. But that is where the real skill in trading come from, is managing yourself and your emotions. So it's important to position size to where you don't have too high of a position. If you have too high of a position, it's really hard to manage yourself and really hard to manage your emotions because there's more pressure, right? The account heat is higher. So you have to find that perfect amount of shares to buy where if you lose, it's not going to keep you up at night. But if you win, you have a nice run, it can be substantial, right? And it's meaningful. So 10% is identifying the trade, the easiest. Second, 20% is managing the trade after you enter. A little more work for sure, but still pretty easy. But 70% is managing yourself and managing your emotions. And that's why I talk about trader psychology. It's all about managing yourself and your emotions. Get yourself a plan and follow the plan. All right, everybody, let's take a look at the potential trades I have for next week. I think I have some really good ones. And it looks like I have, what do I have? 12 symbols here, 12 tickers. So I always mention this before I go through this, that it's possible Monday all 12 of these could trigger, and they might. And does that mean I'm going to take all 12 signals? No, it does not. I'm going to have to, if I have 12 legitimate signals, I'm going to have to take that 12 and narrow it down to only one. And how do I do that? Well, I look at how many confluences of signals it has. If one ticker has one signal and the other has two, well, I'm probably going to take the one that has two. It has a higher quality score. But sometimes you'll get something with a high quality score, but the risk to reward's not that good. So you kind of back that out of the equation. I also look at higher time frames. What are higher time frames telling me? Do I maybe have, if I'm trading the dailies, maybe do I have a signal on the weeklies that might kind of make a stronger case for my trade? What's the relative strength of the particular market? Is the market down, but this one's up? I would kind of give that an extra bonus point as well. So the devil's in the details, everybody. And for me, narrowing down, even if I have 5 great trades, narrowing it down to the best trade is very important. I think it's really good for you in the long run. And this is what I teach my students. And by the way, I do teach a 20-hour course. I teach people all over the world. The course is one-on-one. I think it's very important when you're learning something that you have the full attention of your teacher so that you can ask him questions about everything. I love to teach. I've been doing it for many, many years. And like I said, I teach students all over the world from absolute beginners all the way up to hedge fund managers and everywhere in between. So if you would like to study with me, it would be great to have you as a student. I will teach you everything that I know. I'll teach you step by step every single rule. And how to set up the trades, how to manage the trades. I throw you a lot of curveballs. Just make sure you're listening, right? Because it's important to me that you succeed as a trader, and I will teach you everything that I know. And if you follow everything that I know in the long run, I'm sure you're going to be a profitable trader. I've been doing this for over 30 years. So if you're interested, just send me an email. My email is in the link of this YouTube video. Just reach out. If you reach out, I'll reply and say, hey, thanks a lot. Thanks for saying hello. And I usually suggest that we do an initial video call. It's not a sales call, I promise you. I just want to learn more about you, your trading, your trading challenges, your trading goals, and it's a really good time for you to ask me any questions about the course. And then after that, if you're interested, email me back. If you want to take the course, we will start, and I think it's worth every single penny, and I'm sure you'll be glad that you did it. If you like online courses, I also have an online course, a really good one available at udemy.com. It's called the Deep Dip Buy Stock Trading Strategy. It's 9.5 hours of video, and it's really good. It's very affordable, somewhere between 30 and 50 bucks. So if I can help you one-on-one or with the video course, both links are in the description. So, okay, thanks for holding through my little plug there. And now let's get on and talk about the potential trades for next week. Some really good ones, I think. Amazon. Okay, we have an interesting level here. Why did that move? Oh, I know why. All right. This is Amazon. We have an order block here. Why is this an order block? Because we have a swing low, and then we have a swing high, and we have a lower swing low. We break market structure to the upside. Once we break market structure to the upside, I know the lowest closing bar is the smart money area. Now, do you remember when I told you about having a big up bar inside of the order block and then the halfway of that bar being a key level? Well, there we go. Here's the order block. Here's the key level. Now, I don't know if Amazon's going to get down here, but if it does and it rejects the 198.70 level, that would be a potential trade for me. It's a ways up there, so I don't know if it will, but if it does, if it comes down, rejects that level, meaning it bounces intraday, goes under intraday, closes back above, or even closes under and closes over, that's a rejection. And then if that happens, I will consider taking trade, and then my end of our stop would simply be the screen line at 198.70. So we'll wait and see what happens with Amazon. Berkshire Hathaway. All right, BRKB. We have an order block from the past. You can see 2 days we've rejected the high of the order block. That is a legitimate signal, but not the ones that I like to take because the risk reward's not that good. But what I'm looking for is here, see the big bar that we have here on the third big up bar, halfway that big up bar is a key level. That's 477. So I have a couple levels here. The first one is if we reject 477, I could potentially take trade. 477 would be my line in the sand. And now I have another level here at 474.30. Why do I have that? Because these three bars create a V2. Bar 1, bar 2. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. Where's the support level on a V2? Halfway of the second bar. That's why I have the line at 474.30. So really there's three potentials for next week on Berkshire. The first would be a rejection of 477. The second would be a rejection of 474.30. And the third would just simply be a rejection of the bottom of the order block at 473. Let's go to Caterpillar, CAT. Well, Caterpillar had a really, really strong run, and like almost everything else out there, It has given it back, but we have an order block that was formed here on the 23rd of January. Smart money area, bring the smart money area into the future. The prices are starting to approach the smart money area. And I have two key levels inside of the order block. The first is the 100-day moving average. That is the red line. If we come down next week, I don't know if we will. I kind of hope we don't. But if we do and reject 637, that is one entry for sure. The second entry would be here, 629. Why? Up bar here, halfway of that up bar is the 629 level. And then, of course, kind of goes without saying, rejection of the bottom of the order block. The rejection of the bottom of the order block would be 623.57. So three levels, 623.57, 629, or 637. My preference, ideally, would be a rejection of that 100-day moving average at 637. But all the other two that I gave you are completely legit as well. So I'll be watching Caterpillar carefully for that. All right, Dow Jones, DIA. This was a legitimate entry today. And kind of like I was talking about having to pick between the two, both Apple and DIA had valid signals today. I went with Apple with the rejection of the 200 inside the order block, but DIA actually did trigger, and if you can see, it rejected the bottom of the order block and it rejected the purple line, which is the 250-day moving average. I decided to go with Apple, was a little stronger than DIA, and that's why I bought it. But next week, depending what happens, I may enter diamond if I get another signal. And another signal would just mean that next week we went below the 250, closed back above it, or we rejected the bottom of the order block and had a nice gentle close above it. I mean, we might enter down and then close way up here. And at that point, the risk to reward ratio wouldn't be good. So anyway, this would have been a legitimate trade. 100% would have been a legitimate trade today, but I narrowed it down and I decided to pick Apple instead. But really what I'm looking for on DIA next week would just be another opportunity to get in with another rejection of the bottom of the order block or a rejection of the 250, and the 250 is at 454.87. GDX, gold miners, my gosh. Look at this move up, look at this move down. Will there be a bottom? Well, it's a pretty nice setup right here that we're getting pretty close to. We have an order block, the green box from the past, smart money area, and we have the 200-day moving average inside of the order block. It's my favorite. It's my favorite setup. So the 200-day moving average is 76.34. Right now we're at 80.17. So yeah, potential. Now, on this particular trade, I would consider taking a rejection of the high of the order block as well, not just the 200. And the high of the order block looks like it is at 77.71. So if we touch that, close back above it, I would consider taking that trade as well, but I would use the 200 as my end of bar stop. So I hope that makes sense. So the 1771, if we reject that, yes, I could consider taking it, stop below the 200-day moving average. But if it goes down and rejects the 200-day moving average, then I would also, my stop would be that would be a close below the 200-day moving average. Right now, that's 76.34. And then, of course, a rejection of the bottom of the order block is always valid too, 72.99. But I'm going to be watching that one carefully as well. That's doesn't mean it has to work, but that's a really good key level of a 200-day moving average inside a key level of an order block. And clearly, we're way oversold. McDonald's, getting very close. Here's your order block back here on 120. Clearly, that was smart money because after that, it just rocketed up. So when you're up here and you look back here, was smart money buying there? Well, it was after it went way up there. Well, we're getting back down to those levels. And there's two key levels that I'm looking for McDonald's. There's the 200-day moving average. It's the top of the order block. That's 305.25. And then there's the 300-day moving average. That's the orange line at 302.85. Either of those rejections would be legitimate, or a rejection of the bottom of the order block, and the bottom of the order block is at $300.77. Meta. All right, Meta's in the order block. I had a key level from the past here at 594. Had it closed above the 594 level, it would have been a legitimate entry, but it did not. But we are very close to this. So Monday, if we close back above 594, that's only 34 cents away. That would be, depending. If it closed way high, no. But if it had a nice gentle close above, giving me a good risk to reward ratio, I would certainly consider it. So I'm looking for a close back up, a nice gentle close back above 594. Then I would use 594 as my trailing stop level. Microsoft, boy, oh boy. Okay, we have an order block. I guess I should make that green. We have an order block below us. There's a key level inside the order block. Oh, I remember that goes way, 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 way back. So I won't torture you with that. But I remember what it was. This green bar is a halfway of a really big up bar from the past, 370. So if Microsoft next week comes down and rejects 370, that would be my potential level. And then my end of bar stop would simply be a close back below 370. NVDA, very similar to Meta. We have an order block. We have a key level that I put in from the past that was a halfway of a V2 at 173.40. Today, had this closed above 173.40, that would have been a legitimate entry. But as you can see, it closed below. Therefore, next week on Monday or Tuesday or whatever, if we close above 173.40 in a nice gentle way that still gives me a good risk to reward ratio to 173.40, I would consider taking the trade. Philip Morris. Okay, so I covered this earlier in the podcast. I got in the trade, initially moved up nicely. Glad I took some profit targets, but then it closed below the 200. Today, it also closed below the 200. But that 200-day moving average, the reason I took the trade in the first place, is still above us. Therefore, next week, if we can close back over the 200-day moving average, that would be a legitimate trade as well. And the 200-day moving average at the moment is 163.81. The Qs, well, you can see we broke down and closed below that order block. Stayed in there for a long time, but it broke to the bottom. So what happens when it breaks to the bottom? You go looking for other order blocks that are lower. And here you go. Now, this is quite a long ways away, but it's certainly possible with everything that's going on in the world that we could get here. Is there any key level that lives within that order block? Yeah, the 300-day moving average, the orange line. That 300-day moving average is at 560.66. So that's 22 points below us. Will we get there? I don't know. I hope not. But if we do, that would be an interesting key level right there. I'm hoping we don't, but I have to be prepared that if we do, that I have my charts marked up. So what I'm looking for next week, really about the only thing I'm looking for on the Qs, is if we go down, reject the $560.66, 560.66 level, and that I would use the 560.66 level as my end of bar stop. Last but not least is TLT. All right, TLT has this order block that we closed in the order block. You can see this order block is it's not very tall, it's pretty thin. So today, had we closed above the order block, I would have considered taking that. but we closed in it, so I didn't take it. But if it had closed above it, it would have been a rejection of the high of the order block. And because this order block is so narrow, I would have used a close below the low of the order block as my stop. So Monday, depending what bonds do, depending what TLT does, if it closes above the high of that order block, in other words, it rejected the high of the order block, I would consider it. And then I would use a close below the order block, which is about 85.48 as my stop. So anyway, everybody, I hope this was helpful for you today. I hope you learned something. I hope that you have a good weekend and that you're staying safe and following your rules. If I can help you with anything, please let me know. Again, I teach a 20-hour one-on-one course. I will teach you every single thing I know. I also do a lot of private consulting as well. So if there's anything I can help you with, teaching you, counseling you, whatever, right? If I can help, please reach out to me. My email is in the link in the description. And if you send me a message, I'll get right back to you. So appreciate you making it through to the end. I always like to leave off everybody with, listen, there's a lot going on in the world right now, a lot of negative things. We could all use some positivity. And, you know, if you have the ability to do one act of kindness for another human being each day, you know, if you're able, if the opportunity presents itself, why not do it? It's going to make that person feel good. It's going to make you feel good. And I think we need a lot more feel-good stuff going on in this world. Additionally, I'm a big animal lover. So, you know, if you have the opportunity or chance to ever do an act of kindness for an animal that comes across your path, that would be great. They appreciate acts of kindness just like we do. So thanks a lot, everybody. I really appreciate you being here. Hopefully next week will be a little better for all of us, unless you're short. And if you were short, congratulations, because you've really called it. But for the Bulls, I hope we have a better week next week. And I hope you enjoy your weekend. And God willing, I will see you next week. Thanks a lot, everybody. Appreciate you being here. Have a good one. We'll talk to you later. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.